For now, I mean, small caps on the downside. Maybe that's on pause for today. Question is, Taylor, in the longer term, do you back growth stocks or do you back value?
Why don't we ask the man who I think can bring us some perspective on that, Caroline? Richard Saperstein, Chief Investment Officer at Treasury Partners, which manages about $9 billion for clients. Richard was ranked number 6 on 2020 Barron's list of top 100 financial advisors in America and joins us today from Colorado. Lovely Colorado. So curious, then answer that question. Is tech still a good buy? And perhaps days like today when it's down, is it a buy the dip opportunity?
Well, clearly the value dogs and the cyclical stocks and the low quality have worked year to date. But we're in the midst of a massive transformational period of technology being adopted across all industry groups and people. And so our view is to look at these pullbacks in tech, have a long-term view, and apply them to portfolios at more respectable valuations.
Is it a rotation that you see from small to big, or is it growth to value? What is the theme that solidifies your thesis?
Yeah, so all of our portfolios are layered with large cap and small cap. And based on our proprietary models, the small cap and large cap are equally overvalued actually right now relative to the last 10 and 20-year valuations. So I'm not really so concerned about the movement from large to small. I think the most important aspect for investors to look at now is to focus on tech versus value or growth versus value. First of all, value index, the Russell, has Google and Twitter in it. So we can't just sort of ballpark value versus growth. We look at growth in 3 segments. One, you have the startups trading at infinity multiples. 2, you have the post-COVID beneficiaries trading at nosebleed multiples. And finally, you have the large cap tech with significant cash flows, large moats around their businesses, and incredible user penetration. We're focusing on the third bucket for our client investors right now.
But this on a day where the NASDAQ 100 is off by 1%, the NASDAQ full index off by more than that, the biggest losers, the likes of Apple and Tesla. Are these therefore buy the dip moments for you, Richard?
Well, we're not buying Tesla, but we look at operating and free cash flows. So if you take the big fangs, their operating cash flows are roughly, let's call it $60 to $80 billion a year. When you take out CapEx, which ranges anywhere from $10 to $40 billion a year, you're left with very strong free cash flow yields. And we're focused on the companies that are generating operating and free cash flow, and the percentage that those represent are still greater than the cost of capital. So the talk about, rising interest rates are going to knock back tech. Well, I would look at the operating cash flow and the free cash flow. As long as it continues to remain above their cost of capital, that's where I'd be putting my money for the long term.
Richard, fold all of this into Taylor's great love, treasuries and bond markets, because we're seeing, of course, today a steadying of yields. In fact, we were higher after the auction, yields a little bit up. Now we seem to be seeing the yields fall down, money moving into bonds as we see the stock market sell off a little bit more. Are you worried about where yields have been, where they are in future going to go?
Yeah, so there's the narrative that we're in a structurally rising inflation environment, which I disagree with. We're going to see inflation return over the next 3 months due to the base effects from last year's immediate results from the lockdown. But eventually, we're going to resume back to the technology causing disinflation and a normalized inflation environment. So when we relate that to interest rates, we believe that the 10-year will remain below 2% this year and below 2.5% in the following year. Now, in the event we are wrong and we do get inflation and the Fed has to start removing the punch bowl, that's a whole different environment for equities. But as of now, we're not concerned about the 10-year at a 162, a 175, because our companies are growing faster than that cost of capital.
Are clients asking you about Bitcoin?
Sure, we get asked basically everything. But, our focus is on liquid markets, public securities, and, trying to figure out where we can skate to where the puck will be. And I think that, Bitcoin has already had its move.
Richard Saperstein with the last word on Bitcoin for the moment. Chief Investment Officer at Treasury Partners. We thank you for your time. Stay well. Meanwhile, of course, coming up.